Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into a report that will tell us if this fund is making smart money moves or just playing with your cash. Get ready because we're about to decode the BNY Mellon Intermediate Municipal Bond Fund's latest shareholder report. And if you're serious about understanding how your investments really work, make sure you're subscribed and join our Discord community linked down below. Alright, so this document is essentially a yearly checkup for the BNY Mellon Intermediate Municipal Bond Fund. It's like the report card that shows you exactly how the fund has been doing over the last year from June 2024 to May 2025. Let's start with the price of admission. If you put $10,000 into this fund, you would have paid about $64 in costs. That's 0.63%. That might seem small, but remember these costs eat into your returns. Now for the big question, how did your money grow? Over the last year, this fund returned 206%. That's not exactly a wild ride. And here's where it gets a little less rosy. The main benchmark index, the Bloomberg Municipal Bond 7-Year Index, did much better, returning 4.24%. So the fund actually underperformed its benchmark. That's like hiring a guide to climb a mountain and they take the longer, harder path. So what happened? The report says the municipal bond market was a bit bumpy with all the talk about inflation and what the government might do with interest rates. The fund actually did okay with some of its choices, like focusing on airport education and local government bonds, what they call general obligation bonds. But they also got hit because they were holding onto bonds for a longer time. When interest rates go up, longer-term bonds usually lose more value. And to make things worse, their choices in areas like public power, transportation and healthcare bonds didn't pan out as expected by their security selection, they call it. They also took fewer bets on general obligation bonds compared to revenue bonds, which also hurt them a bit, a slight detraction as they put it. Let's zoom out and look at the last decade. Remember, past performance is no crystal ball for the future. This graph shows how $10,000 invested back in 2015 would have done. Looking at the average returns over different periods, we see the 1-year return was 2.06%. The 5-year return was 0.68% and the 10-year return was 1.80%. Now compare that to the Bloomberg U%. Again, the fund lagged behind this broader index too. Even the more specialized Bloomberg Municipal Bond 7-Year Index returned 2.08% over 10 years, which is still better than this fund's 1.8%. It seems in the long run, this fund hasn't quite kept pace with its benchmarks. Let's look at the fund size and holdings. It's managing $366 million and holds 189 different investments. That advisory fee they collected, that amounted to a whopping $1,724 for the year. And how often are they buying and selling? Their portfolio turnover rate is 25 to 19%. That means they are actively managing the portfolio, but it's not a frantic trading spree. Now let's get to the juicy part, the actual investments. As of May 31st this year, the fund held a lot of municipal bonds. They had about $360 million in investments. They've got bonds from places like the Arizona Industrial Development Authority and the Washington Housing Finance Commission. These are backed by specific revenue streams. Altogether, these types of bonds made up about $2.1 million of their holdings. The vast majority, almost 98.2%, are these long-term municipal investments. In Alabama, they've got bonds for things like the Birmingham Jefferson Civic Center Authority and Jefferson County. These total over $14 million. For Arizona, they're invested in bonds for industrial development and civic improvements, totaling over $6 million. California investments are spread across housing finance, airport systems, and school districts, amounting to over $10 million. In Colorado, they have bonds for health facilities and school districts, plus some tribal go bonds, totaling over $5 million. Connecticut bonds include general obligation bonds and those for health and educational facilities, adding up to over $8 million. They have a smaller investment in Delaware Economic Development bonds worth just over $1 million. The District of Columbia has revenue bonds making up about $2 million of the portfolio. Florida investments are quite diverse, including airport systems, expressway authorities, water and sewer projects, and health facilities totaling close to $14 million. Georgia holdings include development authority bonds and municipal electric authority bonds, totaling over $9 million. They have airport system revenue bonds in Hawaii, totaling just over $3 million. Now, Illinois is a big one. They've got over $28 million invested across Chicago bonds, various authorities, and transportation systems. That's a significant chunk of the portfolio. Indiana investments are in finance authority revenue bonds and hospital authority bonds, totaling over $7 million. Iowa holdings include tobacco settlement bonds and gas project revenue bonds, totaling about $2.5 million. Kentucky investments are mostly in public energy authority revenue bonds, totaling about $3.5 million. Louisiana has sales tax district bonds, and those related to oil companies coming in at around $3.2 million. Maryland investments are focused on health and higher educational facilities and stadium authorities, totaling over $6 million. Massachusetts general obligation bonds and Development Finance Agency revenue bonds make up about $6.2 million of their holdings. Michigan is another significant investment with over $17 million in bonds for downtown development, authorities, convention facilities, and water supply systems. They have a smaller holding of just under $1 million in Minnesota revenue bonds for a school district. Missouri investments include health and educational facilities and joint municipal electric utility projects, totaling almost $5 million. Nebraska holdings are in the Omaha Airport Authority and Public Power District bonds, totaling over $3 million. Nevada investments cover school districts and transportation projects, total about $3.2 million. New Jersey has a significant concentration with over $12 million in economic development bonds, higher education, and transportation trust fund bonds. New York is a major player with over $24 million invested in Metropolitan Transportation Authority bonds, city bonds, and Transportation Development Corporation bonds at various airports. North Carolina holdings are in airport revenue bonds and Medical Care Commission revenue bonds, totaling about $3 million. Ohio investments are spread across tobacco settlement financing authorities and water development authorities, totaling over $13 million. Oklahoma has a large position in Grand River Dam Authority revenue bonds for about $3 million. Oregon investments include general obligation bonds and revenue bonds for facilities and sewer systems, totaling over $7 million. Pennsylvania is the largest state allocation with over $33 million invested across various municipal authorities, school districts, and transportation systems. That's a big bet on the Keystone State. South Carolina holdings are in Ports Authority revenue bonds and Public Service Authority revenue bonds, totaling over $7.6 million. Tennessee investments include health facilities, board revenue bonds, and energy acquisition corporation revenue bonds, totaling just over $4 million. Texas also boasts strong holdings with over $25 million in independent school districts, utility systems, and airport revenue bonds. They have a small allocation of $2.5 million in Puerto Rico bonds. Utah investments are in power agency and airport revenue bonds, totaling over $8 million. Vermont has a holding of just over $2 million in Student Assistance Corporation revenue bonds. Virginia investments include Transportation Board bonds and Small Business Financing Authority bonds, totaling about $53 million. Washington State has a robust presence with over $21 million in energy revenue bonds, hospital district bonds, and Port of Seattle revenue bonds. West Virginia has an Economic Development Authority bond for about $1.8 million. Wisconsin is a significant holding with over $20 million in general obligation bonds from Milwaukee and various Public Finance Authority revenue bonds. As of May 31st, the fund's total net assets were about $365 million. Looking at the balance sheet, its assets were around $368 million and its liabilities were just under $2.5 million. In terms of operations for the year, they earned about $12.7 million in interest income. After deducting expenses, which came in at around $24 million, their net investment income was $10.3 million. On the investment side, they had a net realized loss of $1.3 million and a change in unrealized appreciation or depreciation of negative $653,000. This resulted in a net increase in assets from operations of about $8.3 million for the year. Now let's look at how the net assets changed. Overall, the net assets decreased by about $26 million during the year. This was mainly due to shareholders cashing out more money than they put in. The financial highlights table gives us another view. The net asset value per share at the start of the year was $12.50 and ended at $12.42. The total return for the year was 2.06%. This again confirms that the fund didn't perform as well as some of its benchmarks. The expense ratio is 0.63%, which aligns with the cost we saw earlier, and the portfolio turnover rate stands at 25.19%, showing moderate trading activity. The notes to the financial statements explain that they value their investments using an independent pricing service based on observable inputs like comparable yields and dealer indications. Most of their investments fall into level 2 of the fair value hierarchy, meaning they are valued using observable market data. The auditor's report confirms that the financial statements present fairly the fund's financial position and results of operations in line with generally accepted accounting principles. They've been auditing investment companies for a very long time. An important note here is that the fund is reporting its dividends as exempt interest dividends. This generally means they are not subject to regular federal income tax, which is a key benefit for anyone investing in municipal bonds. Interestingly, the board members are on the boards of many other BNY Mellon funds too. Their fees are allocated based on the size of each fund's assets. The total paid to board members and the chief compliance officer was about $60,000 for the year. So here's the deal. BNY Mellon Intermediate Municipal Bond Fund offers tax-exempt income, which is its main appeal. They've got a solid, diversified portfolio of municipal bonds spread across many states and sectors. However, the performance over the last year and even over the last decade hasn't been stellar when compared to its benchmarks. They've lagged behind, and while their long-term bond picks did hurt them in a rising rate environment, the overall strategy seems to be a bit conservative, perhaps too conservative for some investors. The fund is well managed in terms of compliance and auditing, but the real question for investors is growth. If you're solely focused on stable, tax-exempt income and aren't overly concerned about outperforming the market, this fund might fit your needs, but if chasing higher returns is your game, you might want to look elsewhere. What are your thoughts on this fund's performance and strategy? Let me know in the comments below. If you found this breakdown helpful, don't forget to smash that like button and subscribe for more of these deep dives. And seriously, join our Discord community. It's a great place to connect and learn. Thanks for watching, and we'll see you in the next video.